Good afternoon. My name is Kale Mujisha, and me and my colleagues will be talking about stock market prediction, and that they relate to probability and statistics. So, first, what's a stock market? A stock market is a collection of markets and exchanges where regular buying and selling of publicly company stocks are held. So, in our presentation, we want to focus on mainly the Apple stock, but also giving examples on other company stocks. So there's something first I want you to note that stock prediction is not accurately cannot be accurately 100%. Say you cannot expect to get, though it might happen, you cannot expect to get like 100 results of what you wanted because of unforeseen situations that may arise. Talk about what happened in this recent month, which the corona period, the COVID-19, where say companies like Airbnb, which were making a lot of money, decreased their stock value decreased drastically because now people are stuck in their home. People cannot move. And then since the Airbnb business model was based on specifically people traveling, now since they can't travel, like the stock is not making that well. While in consideration to in what I said, where unforeseen situation can be of favor to people. Now that in the corona period, say the Zoom stock rised a lot. Since people are stuck at home, they can't attend in-person meetings. They have to do online meetings, and which made people a lot more people use Zoom, and more their stock value increased. So the the focusing on as I said on the stock market, it was not an easy task due to the non-linearity and dynamism of the stock markets, of how the outcome might be. But we came to use a model, a machine learning model, which helped us to predict how a stock will how its value will be in the future. My colleague will talk more about that. Uh,
Oh, okay.
yeah, I think this is where she comes in. Thank you.
Okay. Hi, my name is Fiona, and I'm going to briefly talk about the model that we used. And the model that we used is what is called a long short-term memory network, which is a machine learning model. And as you can see here, it's used to maintain, update, and regulate the states of a network model outside of its normal execution flow. With that said, it would help to know that it's part of recurrent neural networks. And in machine learning, what you'd compare this to in real life is like how your brain works with the neurons. And the RNN, or recurrent neural networks, try to mimic this. So, so the process of the LSTM model is that we had to put data into it, and it uses hyperparameters. And these hyperparameters are what we use to train our data set. So the hyperparameters that we used in our case were the closing price, the high price, the low price, and the actual opening stock price of Apple in the past few years. So what happens with the data is that it has to be pre-processed, and then it has to be clean, and then everything had to be scaled down, and we used we scaled it down to 0, 1. So here as you can see, we imported different libraries from Pandas, NumPy to help us sklearn. Keras applications are deep learning models. So we used all this to help us visualize and train the data set. So the first step is we visualize the closing price history. And this is the graph of Apple stock from 2012 to I think around 2020, because we're trying to predict from 2020. And this is from to 2021, where we have the actual closing prices. And then as you scroll down, you see that this is where everything that I was talking about happened. So we had to clean it, and then we had to train it, and then we put it through arrays to help it form a shape that's accepted by the actual machine learning model. And then here, the calculations you see here, just there. So an RMSE is the root mean square deviation. And what this is it's a square root of the mean square error. And the mean square error in this case is what we use to measure the differences between the values, between the sample and the population values, to help us test the accuracy later on. So this is the graph we got. So as you can see here, our model, so the red line of the graph is the actual closing stock price, sorry, and the orange is our prediction. So I'd say that this is a very high accuracy because they have close values, but as you can see, somewhere between 2020 and 2021, around this point, you can see where there's a high peak colored, if you would just circle that here, where there's a high peak. Okay, so yes, there, yeah. So here you start seeing that our models performs better on the actual data set than on our trained data set. And this might cause a case of overfitting, where if it goes further and the actual difference increases, then you find that maybe our model says that the price is going to be $60, when in actual sense it's going to be $120. And this can cause a lot of complications for someone who's relying on this model solely to decide how they're going to buy and sell stock and when the right time to get into the market is. So there are a couple of assumptions we made as we were going into this model. We assumed that everything around Apple was involved. So everything was considered. The other thing that we assumed is that the price of Apple stock in our prediction is already affected by trends. So as Caleb talked about how Corona affected certain businesses, and like now Apple's released a new phone, so their stock is going up. So we assumed all of that is already there, and that the history of Apple's stock prices repeats over time. So one of the biggest limitations that you come to see this model is that you can't use it for a very long time because it has short-term memory, and it's very good for predicting short-term forecasting series like day-to-day trading or rainfall in a short period of time. So with that said, it could be more accurate if you put in more parameters. And if you were to use such a model to predict your stock, it's advisable that you combine bunch of things because of sentiment analysis, which is where we look at how the market affects stocks. So not just look at the numbers, but also look at the market, the politics. So as an investor, this is good for an investor who's trades for short-term stock and also considers other factors in there. And if this could be improved, then maybe this could be the future of stock trading, where your machine does everything for you, considered with all factors considered. Yeah.
So
Kyla will conclude.
Yeah, one last thing to notice, stocks exhibit a log-normal distribution. A distribution is mainly how data points are distributed across a graph. So it has both an exponential and normal distribution characteristics, but it can't be represented as a normal distribution, because a normal distribution might start at some negative side, uh, while the log normal distribution doesn't start on, while a stock can't be negative, therefore it has to start at some positive point position. Sorry. So we hope you enjoyed our presentation. That was all. Thank you very much.
Thank you.